Welcome back to Financial Excellence, the place where we turn financial confusion into clarity and hard-earned money into lasting wealth. Let's face it, the world of personal finance, investing, and growing your net worth can feel overwhelming. With so much noise out there, it's hard to know who to trust or where to start. But you don't need a degree in economics to take control of your financial future. You just need the right roadmap. On this channel, we break down complex money concepts into simple, actionable strategies. Whether you're looking to master budgeting, build smart investing habits, scale your income, or achieve true financial freedom, we've got you covered. If you are ready to take your finances to the next level and build the life you deserve, hit that subscribe button and ring the bell so you never miss a video. Let's build your financial excellence together. Welcome aboard.
Imagine two people. Both earn the same salary. Both invest every month. Both have access to the same stock market, the same information, and the same opportunities. Fast forward 25 years. One quietly becomes a millionaire. The other is still living paycheck to paycheck, wondering why investing doesn't work. So what happened? Was one simply luckier? Did one discover a secret stock? Or is there something that almost nobody talks about? Here's a shocking reality. Most people believe investing is about finding the next Tesla, Nvidia, or Bitcoin. But history tells a completely different story. The biggest reason people never become wealthy isn't because they pick bad investments. It's because they make bad decisions. Today, we're uncovering the hidden mistakes that keep 90% of investors from ever getting rich. And more importantly, how you can avoid them. Because becoming wealthy isn't about being smarter. It's about making fewer mistakes than everyone else. Let's begin. Chapter 1. They chase quick money. The biggest investing myth is that wealth happens overnight. Social media is filled with stories of people turning $1,000 into $100,000. You see screenshots, luxury cars, trading profits, crypto millionaires. What you don't see are the millions of people who lost everything trying to copy them. Real wealth grows slowly. Think of investing like planting a tree. The first few years look boring, very little changes. Then something magical happens. The roots become strong, growth accelerates. Money works the same way. The first $10,000 is difficult. The first $100,000 takes discipline. After that, compound growth begins doing most of the work. But most investors quit before reaching this stage. They dig up the tree every few months to check if it's growing. That's why they never enjoy the harvest. Chapter 2. They let emotions control money. Imagine the stock market drops 30%. News channels scream market crash. Friends panic. Your portfolio turns red. What does the average investor do? They sell. Now imagine 6 months later. The market recovers. Prices reach new highs. Guess what they do? They buy again. Notice the pattern? Buy high, sell low. Exactly the opposite of what creates wealth. Fear and greed are responsible for destroying more wealth than bad investments. Professional investors understand something important. The market rewards patience, not panic. Every market crash in history has eventually been followed by recovery. Yet every crash convinces people that this time is different. Usually it isn't. Chapter 3. They try to time the market. Everyone wants to buy at the bottom. Everyone wants to sell at the top. Almost nobody succeeds. Why? Because no one consistently knows where the top or bottom is. Even professional fund managers struggle. Imagine missing just the 10 best days in the stock market over 20 years. Your total returns could be cut dramatically. The problem is those best days usually happen immediately after the worst days. If you're waiting on the sidelines, you miss both. Successful investors don't predict. They participate. Instead of asking, when should I invest? They ask, and how much can I invest every month? That small shift changes everything. Chapter 4. They keep changing strategies. January, stocks are exciting. March, crypto looks better. June, real estate seems safer. September, gold becomes popular. December, back to stocks. Does this sound familiar? Many investors never stick with one strategy long enough for it to work. Every year they start over. Every year they chase the newest trend. Imagine planting 10 different seeds, but digging each one up after 2 weeks because another plant looks better. None of them will grow. Consistency beats constant switching. The richest investors often follow surprisingly boring strategies because boring works. Chapter 5. They ignore compound interest. Albert Einstein supposedly called compound interest the eighth wonder of the world. Whether or not he actually said it, the principle remains powerful. Let's imagine two investors. Investor A starts at age 25. Investor B starts at age 35. Both invest the same amount every month. By retirement, Investor A often ends up with dramatically more money, not because they invested more, because time invested more. Compound interest rewards patience more than intelligence. Every year, your investments earn returns. Then those returns begin earning returns. Then those returns earn even more returns. Eventually, money begins working harder than you do. That's when wealth becomes unstoppable. Chapter 6. They spend more as they earn more. This is called lifestyle inflation. You receive a raise. Instead of investing it, you upgrade your phone, your car, your house, your vacations, your subscriptions. Your spending rises with your income. Years later, you earn twice as much, but save exactly the same amount. Many high-income earners stay broke because every pay raise disappears into a more expensive lifestyle. Wealth isn't determined by income. It's determined by the gap between what you earn and what you spend. The bigger that gap, the faster your investments grow. Chapter 7. They don't diversify. Putting all your money into one investment feels exciting until something goes wrong. History is filled with companies that looked unstoppable. Some disappeared completely. Even great businesses can fail. Diversification isn't about maximizing profits. It's about surviving mistakes. Successful investors understand they don't need every investment to win. They simply need enough winners to outweigh the losers. Diversification keeps one mistake from becoming financial disaster. Chapter 8. They follow the crowd. Here's an interesting observation. When everyone talks about an investment, it's often already expensive. During market booms, everyone becomes an investing expert. Taxi drivers recommend stocks. Family members discuss crypto. Social media guarantees easy profits. That's often when risk is highest. Meanwhile, during market crashes, nobody wants to invest. Ironically, that's often when opportunities are greatest. The crowd usually buys because prices already went up. The wealthy buy because value exists. There's a huge difference. Chapter 9. They have no plan. Imagine boarding a plane. Halfway through the flight, the pilot announces, "I actually don't know where we're going." Would you stay calm? Probably not. Yet millions of investors treat money exactly this way. No destination, no strategy, no timeline, no risk management. They simply invest randomly and hope for the best. Hope isn't an investment strategy. Before investing, answer 3 questions. Why are you investing? When will you need the money? How much risk can you truly handle? Those answers shape every decision that follows. Chapter 10. They quit too early. Every wealthy investor has experienced losses. Market crashes, bad investments, economic recessions, temporary setbacks. The difference? They stayed invested. Imagine reading only the first chapter of a book and deciding the ending. That's what quitting early looks like. Investing is a decades-long game, not a 6-month challenge. The market rewards endurance, not excitement. The longer your time horizon, the smaller today's volatility becomes. Time turns uncertainty into probability. Final lesson, the real secret to getting rich. So why do 90% of investors never become wealthy? It's not because investing is impossible. It's because human psychology makes simple things difficult. People chase excitement. They fear temporary losses. They copy the crowd. They expect instant results. They abandon good plans for exciting opportunities. Meanwhile, the wealthiest investors quietly follow a different path. They invest consistently. They ignore daily noise. They stay diversified. They keep emotions under control. They think in decades instead of days. And eventually, compound interest rewards their patience. Remember this. Investing isn't about beating everyone else. It's about beating your own emotions. The stock market transfers money from the impatient to the patient. You don't need perfect timing. You don't need a genius IQ. You don't need insider information. You simply need discipline that most people never develop. Because wealth isn't built by extraordinary decisions. It's built by ordinary decisions repeated for an extraordinarily long time. If today's video changed the way you think about investing, hit the like button and subscribe for more videos on building wealth, mastering money, and making smarter financial decisions. Thanks for watching, and remember, the best time to start investing was years ago. The second best time is today.